afternoon.
Perfect opportunity to show you this wonderful multicolored chart. Tells us when we reached all the significant highs. It didn't take long for the Dow to go from 19,000 to 20,000, second shortest time ever to break a 1,000 level. What next?
Well, I think the key message here is the fact that this has been a really hated rally.
The most unloved bull market.
An unloved bull market. And if you think back to March 1999, when you had that famous picture of the New York Stock Exchange chairman Richard Grasso with Rudy Giuliani, with the Dow 10,000 hat, this was a democratic rally. Everyone was participating. It was .com, and it was felt that this was something for all of America. When the New York Stock Exchange was asked this time around, are you going to print Dow 20,000? The initial response was very reluctant because they were keenly aware of the fact that this was not a widely participated rally. But that in itself actually gives an insight into how the rally is going to develop, because the kind of people who are in this rally, the equity investor profile today, is much more institutional, much more high net worth, much less kind of retail mutual fund. And that means they're probably more likely to overlook short-term political risk and focus instead on the fundamentals.
And this is one of your big themes, isn't it? Because you say last year was an extraordinary year, because despite all the political risk, Brexit, Trump, to name but two, China, three, markets always shrugged it off. Can that be sustainable in 2017?
I think it can, as long as those reasons behind the shrugging off last year persist into this year, and I suspect they will. The profile of equity ownership hasn't changed yet. There's some evidence that retail investors are starting to come in. That's going to take a long time, though. But the other two big reasons for equity markets ignoring political risk is, one, bank liquidity was still good. So the banking system functioned, unlike in 2008. We see no reason for that to stop. The other reason is that actually global growth and corporate earnings are pretty healthy. And we've seen that already with earnings season so far in the US. The beats rate is quite good. We've seen good results from Boeing. So there's no real reason to start panicking over short-term political risk. Later on, maybe if the kind of participation in equities becomes a bit more retail, it might get a little bit more flighty. I think that's a problem for 2018 or later in 2017.
What about correlations? Do we see a shift in what asset classes move together now?
Well, I think certainly within the equity market, we can see that there's increased dispersion. And I think that's probably because of the Twitter effect from Donald Trump, in part. He's creating a bifurcation within equities. And I think fund managers are going to have to be very light of foot to steer around this. I think Boeing is a prime example there. Because basically one minute he's criticizing Boeing for the very expensive presidential plane project, and the next minute Boeing's actually announcing results and saying, hey, the 787's making a lot of money. So that's quite problematic within the equity market. And I think across asset classes, well, hopefully we'll see that actually bond yields will pick up as equity markets move up. So you'll see bonds having that traditional kind of low correlation to equities in the coming months.
And what about corporate earnings? So we do get them in the US this week, a whole bunch of them, more than a quarter of the S&P 500 market cap. What can we anticipate that might trip up this rally? Well,
it would have to be something fundamental. So corporate earnings, as you say, would be one thing, but we simply don't see it. I mean, corporate earnings in Q3 in the US came out of recession. After, I think, 5 or 6 consecutive quarters of year-on-year decline. So Q4 should hopefully get us clear above water now in terms of the year-on-year improvement in earnings. So I don't see the trip up coming from there, and I don't really see it coming from growth either. I think later this week we've got the US GDP number. Anything north of 2%, I think, will be quite well received by the market.
There's a great Bank of America stat, Julian, that I just read. Love this. Being uninvested in the last year of a rally means missing out on a 1/5 of the return. I mean, that's incredible. Does that mean fear can be a real driver of the late stages of a rally? You don't want to miss out, and that just keeps
I think so,
up.
but I think that's a psychological element that is going to affect those retail investors more. So as they open their statements, they're going to say, hey, I've really been missing out on this. I better start participating. As they participate, the nature of the market will change, because it's going to become a flightier market, much more responsive to bad news or political upset. But like I said, that's something for later in the year, probably not for straight away.
When are we going to start sort of swinging from the chandeliers, Julian, about European equities? I mean, I was joking earlier, there's nothing sexy in 349.30 for the stock 600. I mean, the FTSE's at 7,000, maybe one day 10,000 isn't pie in the sky. Where's the love?
Well, we really do like European equities. I mean, if you run a very simple chart of the Eurozone leading indicator against the Euro Stoxx 50, you can see this big divergence. Basically, the Euro Stoxx 50 has been lagging behind the leading indicator. And over time, since like the late 1980s, the relationship is pretty tight. But just over the last 2 or 3 years, it's started to diverge. And again, that could be political risk, but therein lies the opportunity. You know, that's really where you're getting the discount, because the fundamental earnings in Europe are pretty good and growth is improving. We're getting inflation coming through. It's just people are worried about that political aspect.
There'll be a plus behind earnings this year in Europe. There's been many false dawns, of course, hasn't there?
Yeah, the analysts always start optimistic, and as the year goes on, it becomes more and more pessimistic. But I think with global reflation, you know, Europe is quite tied in with emerging market reflation. And put simply, if there's a stimulus plan in the US, that's going to require stuff, and that's going to require machinery from places like Germany.